Hello and welcome. I'm Brian Caplen, editor of The Banker magazine. I'm with Janet Henry, Global Chief Economist for HSBC, and we're previewing the IMF annual meetings, which are going to be in Bali this year. Janet, I'm quite sure they're going to be talking about emerging markets because they're under pressure at the moment, aren't they, with big currency falls. Why is that?
Well, the world has certainly changed since this time last year going into the IMF, because last year it was all about monetary independence in the emerging markets. We had this nice synchronised acceleration, but of course that synchronised acceleration meant that the dollar was actually fairly weak. The euro was actually strengthening. So for emerging markets, what's changed is that the Fed is tightening and the dollar has been rising. So emerging market financial conditions have been tightening more than they have in the US economy itself.
But it seems as if no one was prepared for this.
I think there was certainly an optimism bias because for the most part, the emerging world has built up a lot of defences relative to where they were in the past. Very few economies now in the emerging world actually have sizable deficits. Most of the Asian economies have quite big surpluses. Their defences are higher. And because last year the Fed had been tightening and the dollar had been weakening, a lot of people thought that the dollar would continue weakening rather than actually start to appreciate, particularly when the European numbers, which have been very, very strong last year, actually returned to a more normal trend.
All right, so in that case then, can we say that Argentina and Turkey are kind of exceptions and that this isn't a generalised emerging markets crisis?
Well, it started with the likes of Argentina and Turkey because those were the two countries that since the taper tantrum had actually seen widening deficits. So that seemed quite sensible. Who's going to be under pressure in the event of capital outflow as US rates are rising? It started with those two countries. Then it was the likes of South Africa as well. So all of those economies are already either in or on the verge of some kind of recession. And then it broadened to basically anyone that's got a deficit, which is when you saw a lot of the other Asian economies come under pressure. So Indonesia, India, Philippines, that they, previously when the dollar was weakening, they hadn't been expected to tighten policy. But now with higher oil prices in India and Philippines, they've both seen inflation rise. They've got stronger domestic demand. They've tightened policy. In Indonesia, they don't really have an inflation issue per se, but they are a deficit country. The currency had come under pressure and they found themselves having to raise rates more quickly than had been expected.
OK, now you mentioned that this is mostly off the back of US rates tightening. But the other big sort of political event is the threat of a trade war, particularly between the US and China. I mean, how much is that impacting on the emerging markets or the global economy in general?
I think financial conditions is one important thing. Oil prices, we always neglect sharp rises in oil prices, especially supply-driven ones at our peril. But the broader one is trade wars, but also some slower Chinese growth. Since the start of this year, China was on a very strong footing. Infrastructure spending in particular has slowed quite sharply. So most emerging economies, particularly those in Asia, are more dependent on Chinese demand than they are on US demand. So their export picture was already starting to weaken, and now these trade tensions, which have obviously built since the start of the year, extended to steel and aluminium, and now the more China-specific trade tariffs, even though they've only just started to take effect, they've impacted on sentiment and on investment intentions. And it's hard to see those fading particularly quickly, which is one of the reasons why they're still going to be under pressure in the coming months. But they do at least have the prospect of China starting to deliver a stimulus. First of all, catch up on the underspending at the start of the year and have further cuts in reserve requirements. And that should help to stabilise the Chinese growth, which for Asian countries in particular should provide a degree of stability.
Now, on the question of Trump and his trade wars, I mean, there has been a successful outcome to the renegotiation of NAFTA, and it's got a new clever name, which I think is US-Mexican-Canadian Agreement.
The USMCA, yes.
Okay. But in substance, I mean, has anything really changed?
Elements have changed, and without getting into the weeds, there are going to be certain restrictions on how much of a car input has to be produced by workers that earn $16 an hour. They also have to have a certain amount of North American content, so that could potentially restrict the amount of inputs that come through from other inputs that come through from Asia. They have to come through in North America if you want to be exempt from the tariffs. So I think it adds an extra dimension to the investigation that's already underway in the US regarding auto tariffs globally. and we have to wait to see how that unfolds. We'll know at the latest by February what happens on auto tariffs. And there's also certain elements of the NAFTA 2, as you call it, that could potentially make things a bit more complicated should the likes of Canada or Mexico want to have their own trading deals with what are classified as non-market economies.
Okay, well that brings us very neatly to what's going to happen between US and China then. I mean, in a way, NAFTA was the easy one, wasn't it? Fighting a trade war or getting China to renegotiate the terms of trade with the US is much more difficult and much more challenging.
I think it's all going to take some time because obviously in the US we've got the midterm elections coming up and this deal will have to go through Congress. So we don't know for sure exactly when this new USMCA will start to take effect. It could be as late as 2020 before it actually starts to take effect. So, and as I say, the auto tariffs, the next round of the increase, the planned increase from 10% to 25% on the China tariffs and the possibility of more could be more a 2019 story. So I think it's unlikely we get a quick resolution to all of this. And the broader issue in the US, which is to do with the technology as opposed to the tariffs per se, is the one that has bipartisan support in the US.
Yes.
So that is an ongoing issue that won't be solved in the space of one weekend.
Okay. Janet Henry, thank you very much. We look forward to the meeting.
Thank you.